Look, here's a mistake that could cost you thousands of dollars or even your house. Choosing the wrong way to access your home's equity. See, most homeowners think a HELOC and a home equity loan are basically the same thing, but I'm here to tell you they're not. And honestly, picking the wrong one could lock you into payments you can't afford, or even worse, you could miss out on some serious building opportunities. Hey, I'm Adam Carroll, founder of the Shred Method, and this channel is your go-to for smart and strategic money moves with your home equity. If you've got lots of equity in your home and you've considered tapping it for a purchase or an investment, you've probably heard about HELOCs and home equity loans. Both use your home as collateral, but their uses, their rates, and their repayment styles are worlds apart. So in the next 10 minutes, I'm going to compare the pros and cons of both these strategies and help you choose the one that's right for you. And if you stick around to the end, I'll also share this one strategy that most financial advisors won't tell you about. Let's get after it. What is a HELOC? All right, let's start with the HELOC. That's home equity line of credit. And honestly, the easiest way to think about this is like a credit card, except it's backed by your house and the interest rates are way, way better. So here's how it works. Let's say you get approved for a $50,000 line of credit. Well, you don't have to take all that money out at once. You could take out 10 grand this month, pay some back, take out 5 grand next month, whatever you need. It is super flexible. Now, there's two parts to this thing. First, you've got what they call the draw period, which is usually about 5 to 10 years. During this time, you're basically just paying interest on whatever you've borrowed. So if you take out $10,000, you might only pay like $100 a month. Some lenders may want you to pay a little toward the principal too, but the payment is still relatively low. Then after that draw period ends, that 5 to 10 years, it turns into a regular loan where you're paying principal and interest every month until it's gone. So when does a HELOC make sense? Well, if you're doing home renovations and you need money here and there as the project goes on, this is perfect. Or maybe you want it as a backup emergency fund. You know, it's just sitting there in case life happens. And here's one that might surprise you: debt consolidation. Now, I know some people say never put your house on the line for credit card debt, but if you've got a solid plan to knock that debt out, the interest savings can be huge. The big advantage on the HELOC is you're only paying interest on what you actually use, which is pretty sweet. Okay, now let's talk about the home equity loan. This one's totally different. And honestly, it's way more straightforward. Think of this like getting a car loan or any other regular loan. You apply, they approve you for a specific amount, let's say $30,000. You'll get that entire $30,000 up front, and then you make the exact same payment every single month for the next 10 or 20 years until it's paid off. Done. The interest rate is locked in. Your payment never changes. It's super predictable, which some people really love. So when does this loan make sense? Well, if you need all the money at once, like you're putting on a new roof, you're buying an RV, or maybe you're doing one big renovation project, it's also great if you're the type of person who likes to budget everything out and know exactly what you're paying each month. But here's the catch, and this is important. Once you start paying this thing down, you can't just borrow that money again. So if you pay off $5,000 of it and then find yourself in need of another $5,000, you'll have to go through the whole application process again and pay all of those fees again: origination, underwriting, closing, etc. All right, so how do you decide which one is the right fit for you? Well, I have 4 questions that'll make this super clear. Question 1, do you need flexibility? Like maybe you'll need money in chunks over time, or you want the ability to pay extra when you can. If that sounds like you, go for a HELOC. Question 2, do you want the same payment every month? Some people just sleep better at night knowing exactly what they'll pay. And if that's you, go with the home equity loan. Question 3, are you worried about interest rates going up? Because with a HELOC, your rate can change. With a home equity loan, it's typically locked in. So if rate increases stress you out, the fixed rate loan might be better for your own peace of mind. Question 4, can you handle payments that might go up and down? If the answer to that question is yes, a HELOC could save you some serious money over time. But this is where it gets really interesting. There's actually a way to use a HELOC that most people have never even thought about. Instead of just borrowing money and making payments like everyone else, what if you could use it to actually get rid of debt faster? I'm talking about paying off your car loans, your student loans, your credit cards, and your mortgage, everything way ahead of schedule. Stick around because I'll tell you about that in just a minute. Critical warnings and smart tips. First, let me give you some warnings because both of these can get you in trouble if you're not careful. With HELOCs, the biggest mistake I see people making is just paying the minimum interest payment forever. You're basically treading water financially here. You're not getting anywhere. And look, just because you can afford the payment doesn't mean you should be spending that money. It is not free money. It's debt secured by your house. Also, watch out for those teaser rates. Some lenders will give you this super low rate for the first year or two, and then surprise, it jumps way up. So read the fine print before you go all in. And with home equity loans, the fees can really add up. You've got appraisal fees, origination fees, closing costs. All of these things add up and can be significant. And remember, if you need more money later, you're starting this whole process over again with all new fees. And here's the big one for both of these. Your house is the collateral. I'm not trying to scare you, but you need to be smart about this. Don't use either of these for vacations or new cars or stuff like that unless, and this is a big unless, you have a very specific strategy to do this. You want to use these strategically. All right, let me wrap this up for you. The HELOC is like a credit card with great rates. Super flexible, great for ongoing projects or as a backup plan. Home equity loans is like a car loan. It's a fixed payment. All the money is up front. It's totally predictable. But here's where this gets really cool. What if instead of using either of these to just add more debt to your life, you could use a HELOC to actually eliminate all your other debt? I'm talking about your mortgage, your car payments, your credit cards, everything gone way faster than you ever thought possible. That's exactly what we teach people with something called the Shred Method. We've helped hundreds of families use their HELOC to blast through debt and start building real wealth in record time. If you want to see how this works, head over to theshredmethod.com and check out our free training. If this helped you figure out which option is right for you, smash that like button, subscribe if you want more content like this, and definitely drop a comment below. Tell me which one you're thinking about and why. I read every single comment. Look, your house should be one of your biggest asset building tools, not your biggest liability. So choose wisely, and I'll see you in the next video.